This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com. In this lecture, we're going to look at limited companies. And there is quite a lot we need to go through in this chapter. Not much by way of actual calculations, but quite a lot of terminology and also the layout of the financial statements. So we have a lot to go through, so I will break this down into several lectures. And so far, of course, in all the previous chapters, we've been looking really at just a sole trader. With limited companies, well, although as I mentioned a minute ago, we've got more terminology and changes in layout of the statements, the basic recording of transactions is exactly the same. So all the debits, credits, buy goods on credit, sell goods on credit, and so on. Dealing with accruals and prepayments, dealing with irrecoverable debts. None of that changes at all, whether it's a limited company or a sole trader. Anyway, let's make a start, and you'll see on the first page the key features of a limited company. And I say the key features, I mean, this isn't a law exam, so I certainly don't want to go into all the legal aspects. But the main points are there. First of all, a limited company is a separate legal entity. What I mean by that, if you remember when we talked about sole traders, all the way through we treat the business as though it's separate from the owner from an accounting point of view. But for a sole trader, in law, the business is the owner. If the business does something wrong, it's the owner who can get taken to court. With a limited company, that's not the case. The limited company does exist separately in law. It's created, it's registered, it's separate in law. And if the company does something wrong, it's the company that can get taken to court. Not the owners, unless they were involved in cheating, but that's different. But it does exist separately in law. It's not just an accounting principle. Secondly, the owners of the company, we call shareholders, are separate from the management. The directors. So the shareholders own the business. However, they employ directors to actually run the business. And directors are employees. Any wages paid to the directors are an expense of the business, just like any employee. But they are two different things. All right, in many small businesses, well, and in large ones as well, but certainly in small businesses, it's very likely that the owner is also a director, but they are two separate jobs. As a shareholder, you own the company, the profits belong to the shareholders, and the shareholders get given dividends, which I'll talk more about later, but they're equivalent to drawings. However, the directors, even if they happen to be shareholders as well, the directors are employees of the business, and they will be paid a salary just like any employee. The third thing I mentioned in one of the very first lectures, this business of limited liability. We talk about limited companies, but the limit we're talking about is the shareholders. The shareholders have limited liability. The liability of the company itself is unlimited. If the company owes money, obviously they've got to pay the money. But what we're talking about is if the company goes bankrupt, if it collapses, and it can't afford to pay out everything it owes, Well, the shareholders aren't responsible. The most they'll lose is the money they've got invested in the business. So if as a shareholder I've invested 2,000, I'm risk losing that 2,000. But I can't lose any more, even if the company collapses owing millions. And mainly for that reason, there are many more formalities involved. More laws, more rules relating to limited companies. You see, a sole trader, if you trade with me as a sole trader, if you sell me goods, you know that if the business doesn't pay, you can take me to court. And if you know I'm rich and I've got a big house and a big car and things, you won't worry too much about selling to me because you know you can take me to court. With a limited company, doesn't matter how rich the shareholders are, you can't take the shareholders to court if the company hasn't got enough money to pay you. And so you need to be able to check that the company is profitable, has got cash and so on. And so there are many more formalities. That's information that has to be provided in the financial statements so that people thinking of selling to you can check the state of the business. That's for most limited companies, there have to be audits. People have to check the accounts to make sure what's there is genuine. So, sorry about my writing there, but those are the key differences as far as this exam is concerned. Over the page, there are notes about the layout of the financial statements, which is one thing that changes. And rather than read that to you, let's actually look at the financial statements. And I can highlight what's different and what's involved. And so first of all, over the page, the statement of profit or loss. A limited company will produce effectively two statements of profit or loss. They'll produce one statement just like that for a sole trader. The sales, less cost of goods sold, less all their expenses. Listing each separate expense, electricity, telephone, etc. And they'll produce that, and that's useful for them when they're managing the business. They want to know, have we spent more on electricity this year, and if so, why? However, the statement that's actually sent to shareholders and the statement that's filed with the state, we don't want to give too much detail because anybody can look at it. We don't want our competitors, for example, to see every single item of expenditure. And so, what we call the published statement, the statement that's sent to shareholders, the statement that anyone can look at, is very much summarised. And I hope you've got the page in front of you. I'm not going to write it all out. But there is an example of a limited company statement. We start with the revenue. We have to show the revenue, the sales, the turnover. Here, 100,000. The cost of sales. We're not required to show the breakdown, opening inventory plus purchases. That's not required. They'll have done separate workings. But on the published statement, we just show the cost of sales, here 40,000, giving a gross profit of 60. Any other income would be disclosed, it is there, bringing us up to 62,000. But as far as all our expenses are concerned, as I said, we're not required to show each individual item. We just show it under two headings. Distribution costs, and they're all the costs relating to selling and delivering the goods. So distribution costs are things like, if we've got delivery vans, the wages of the drivers, the depreciation of the delivery vans. It's selling costs as well. So the wages of our salesmen, saleswomen. If our salespeople have their own offices, the rent of their offices. So there could be lots of different expenses, but instead of showing them all separately, we just show it as one total. Selling and distribution, selling and delivery. The other heading, administrative expenses. They're all the costs associated with actually running the business. So the wages of the accounts department is an administrative expense. The wages of the reception. Depreciation of the computers in the accounts department. The rent of the administrative offices. The electricity to light the accounts offices and so on. Again, lots of individual separate expenses, but we're simply required to show just one total, here 9,000. That's brought us to a profit of 27,000. Two items that have to be shown separately and in this order are, first of all, finance costs or any interest paid. So if the company's borrowed money and is paying interest, then that expense has to be disclosed separately. Here we say it's 2,000. That brings us down to a profit before tax of 25,000. And although you can't be asked to calculate tax, this isn't a tax exam, limited companies, the company has to pay tax. Unlike sole trader, it's not the business that pays the tax, it's the owner. You know, if I'm a sole trader, I pay tax on all my income, including the profits from the business. But because a limited company is separate in law, the limited company is charged to tax. And as I say, you can't be asked to calculate it. But whatever the tax expense is for the year, well, it has to be shown separately, as you can see there, as an expense in arriving at the profit. That's the expense for the year. As you see later, we won't normally know what the tax is until the end of the year, when we know what the profit is. And so it probably won't have been paid yet. You'd expect to pay tax sometime in the following year. But on the statement of profit and loss, like all expenses, it's the cost for the year, whether we've paid it or we haven't. You'll see when we come to the statement of financial position, if the tax is still owing, it'll be shown as a liability. So that's simply a layout exercise. I said I don't want to each lecture to be too long, so I'll stop this one here, but then in the next lecture we'll look at the statement of financial position, where there is quite a bit more I need to discuss.